Hi Arjun. Hi Dhruv. Today, what's interested news? We are talking about mutual fund. Oh, that's really interested news. Let's go. What is mutual fund? How to invest in it? All you need to know. People invest the money so that they don't lose their value. Kept just lying. There are different places to invest. Our country has mainly 4 places for investment. 1. Saving account. 2. Fixed deposits. 3. Gold and jewelry. 4. Real estate. People buy properties and land or house. Some people, who want to take more risk, also invests in stock market, which is another way to invest your money. Every investment has 3 things: return, risk and time. Return means, how much % of profit are you earning through the investment? And our inflation rate is 4%. Then you should see that your profit return is more than at least 4%. Otherwise, there is no point of investment if you have put your money and the value didn't increase. Because the inflation rate is also increasing. Risk means how risky it is to invest. What is the chance of losing all your money in that investment? What is the chance of going in loss after investing there? And time means for how long are you investing? So, the basic risk here is that if the time is more, risk is more, then the returns will also be more. If you want more return percentage on your investment, then you will have to take more risk and should invest for a longer period. Saving accounts has the minimum risk, and there is no restrictions too. You can save or take the money out at any time. But the return we get here is also very less, only 4%. Whereas our inflation rate in the last few years have been 4-5%. Fixed deposit is also a less risky option, but it has a time limit. Before that we can't take the money out. Hence, the return is also a bit more. 7.8%. Gold and jewelry these days have a significant risk. If you are going to see this history, then you will know that, until 2012, the prices were consistently increasing. If you have invested prior to 2012, then you would have got a good return here. But after 2012, there have been a lot of ups and downs. But they have maintained a level, hence there's not a much profit. Investment in the properties and real investment has low to moderate risk. March 2011, it has touched the return rates of 30%. One of the disadvantage investing in housing is that it needs a lot of capital. You need to have lakhs and crores of rupees to invest. So, this is a disadvantage. You might have heard about stock markets. You can get a lot of returns here but also loss. The risk of investing in stock market depends on the stock. Where are you investing? You need to have a good knowledge of the performance of the stock and how does the stock market works. You shouldn't be investing here if you don't have the knowledge. Few types of investment are there, that is government bonds, corporate bonds. We have cryptocurrency these days. People also invest in bitcoins. You should never invest your money only at one place. You should invest at different places. So, that if there's any crash, then you will not have to bear the overall loss. It's a very less chance of everything crashing. Altogether, like gold, properties, and stock market, as this happen were rarely. Chances are that if anything crashes, then you can get profit from the other. This is called a diversification. You have to invest at different places. Mutual fund is a special kind of investment through which you can invest on different types together. You can do a diversified investment by investing at one places. Asset management company starts mutual funds. Basically, you give your money to a asset management company, and many people like you do, so that company invest all the money collectively at different places. They have appointed experts, and with their suggestion, they invest their money. They invest money at different places, and the return rate they get collectively from these different places out of the small % of 1-2% is kept as a profit by the asset company, and the rest you get back as per that return rate. HDFC, HDPC, Aichi, Aditya Birla, Reliance, Tata. These are the few examples of companies and banks who have their own asset management company. All the companies start different kinds of mutual funds in large numbers. For example, Aichi has started more than 1,200 mutual funds. So, how risky is your mutual funds? And what is the return depends on the mutual funds that you are investing in. Mutual fund can give the return rate of 4% and also more than 30% too. It can be zero risk and also high risk too. Variety of risks. Because all this depends on where the assets management company is investing your money. If that company is investing on stock, then it will be more risky and you will get more returns. And if it's investing in the government bond, then it will be less risky. Types of mutual fund: equity mutual fund, debt mutual fund, hybrid mutual fund, and equity mutual funds. Your money will be invested in the stock market. So naturally in these types of mutual fund generally, the risk is more and also return. In the stock market, on which kind of company are you investing? If it's a big company, then it's called a large cap equity funds. If it's a small company, then it's called a small cap, and in the same way mid cap equity funds. Big company doesn't have much risk as compared to the smaller ones, but big companies won't have growth rate as high as it can be for the smaller companies. So risk and return both are less in big companies. Aichi Prudential Blue Chip Fund is an example of large cap equity fund. If you invest here for a year, then after a year, your expected return is of 11.3%. But if you invest for 5 years, then your expected return can be of 19.7%. But one thing keep in mind, friends, that this is an expected return, not the guaranteed return. It still depends on the market. Since the mutual fund has given such a performance in the history, that doesn't mean that will perform the same way in the future. It still depends on the stock market, so it will have risk, especially because it's an equity mutual fund and investment is on the stock market. So you don't just look at the returns rate and invest. You will see the pros and cons too. Pros means is that the risk is lower as compared to the benchmark. This means, among all the other large cap equity fund, the benchmark of the risk particular fund is less. So this is a good point here, that compared to the other ones, this has less risk. Basically, the commission for investing in your behalf, so this is lower as compared to the others. If look at the more pros, then you will see, then its return are more than the benchmark, first year, third year, fifth year. In some mutual fund, they give 1 year, one return more than the benchmark and less in 3 or 5 years. That means it's better for short terms. Look at the pros and cons, friends, and decide what is better for the short term. Cons means that asset under management. That means they have total value of the money. This company has invested at different places, has crossed 15,000 crores. So, it happens that, if the value crosses a particular point, then returns rate gets decreasing slowly. Because the value of the money is so much that taking return is difficult. Diversifies equity funds. The investment is done in the large, medium and small cap, or it's done in different companies. The equity-linked savings schemes, that is ELS. This is a special type of equity fund, where you can save our tax. You can save the tax on its profit. The fund manager purposely invests on such places where there's high return and also high risk. Sector mutual fund, here specifically, such companies are invested on, which belongs to a big sector like agriculture sector. All the companies, which are under the agricultural sector, they are invested on logistic or transport sector, so there. One example for this is UD Transportation and Logistics Funds. So, the investment is done in that sector. These funds are more risky, since all the investment is done in one sector, so if the sector is going down, everything depends on that. Last type of equity fund that I would want to tell is index fund. Index funds are passively managed funds, that is no agent of AMC is looking at where to invest money here. These are passively managed, that is according to the market's rates is up and downs, they too going down. Liquid fund are those mutual funds, which can be easily and quickly can be converted into cash. Asset liquid fund is one such example, where you will get the return of 7.1% in year. since the last 5 years, it increasing slowly with this percentage. Gilt funds. These are those funds where investment are done on the government-issued bonds. So technically it has zero risk, because it's very possible for the government to not return your money. Most the interest rate can fluctuate. Fixed maturity plans. This can be considered as an alternative to fixed deposit, because it has very low risk. Fixed deposit, and it is done for a fixed time. For a specific time, investment is done here. And you can't take the money before that. Hybrid mutual fund, it's basically a mixture of a debt and equity mutual funds. Some people want to invest in the stock market, but don't want to invest all the money there, and also invest some amount in the debt instrument. So, a hybrid mutual fund are for them. If most of the money is invested in a debt funds, then it will be called as the balanced savings funds. Approximately the ratio is 70-30. That means 70% of your money is at the low-risk debt funds, 30% is in the equity funds. And if it's the other way, 70% is in the equity funds at the higher risk, then it is called as the balanced advantage fund. And hybrid mutual fund, there have different types, like arbitrage fund. Diversification as compared to the stock market, gold, real estate, mutual fund are less risky. However, the exact risk depends on the mutual fund that you are investing on. One more good advantage is that it is affordable. You don't have to invest a big amount altogether. You can use SIP and invest small amount every month. And all the investment of the mutual fund. The professional expector fund manager who decided where to invest and where to not. Disadvantage. An unknown person, you don't know how it's going to perform. However, he is an expert, but you can't trust 100% that an expert will be right all the time. But the biggest disadvantage that used to be for the mutual fund earlier is that the agents used to take a lot of commissions for investing in the mutual funds. The money we will invest for you in the mutual funds and deduct a lot of commissions for themselves. Every month, when your salary is credited, then you keep some part of the salary as savings. You keep some money for you later, use maybe for emergency, or you want to buy the house or car and you save that. So, what are the ways to save? One simple way is that you keep your salary as it is in the bank, and it's get collected. It's a very bad way, friends, because such a money loses their value. Inflation is increasing in our country, and due to that, the price of commodities are increasing. So, the value of money keeps decreasing every year by 4.5%. According to this inflation rate. Okay friends, I pray to everyone, earn money in mutual fund. Today video over. Let's see another video. Bye. Don't forget to subscribe friends.